Right now, a major Wall Street bank is processing a $50 million cross-border trade. But if you walk onto the trading floor, nobody is touching a keyboard. In fact, the person who approved the transaction doesn't even exist. For the last few years, the financial world has treated artificial intelligence like a smart intern, something you use to summarize boring reports or draft emails. But in 2026, the global banking system quietly crossed a terrifying new threshold. We have entered the era of Agentic AI. This is the strange reality where megabanks are handing over actual transactional authority to autonomous software. These systems aren't just giving advice anymore. They're clearing trades, managing risk, and moving billions of dollars on their own, completely unprompted by a human. By the end of this video, you'll understand the massive hidden risk threatening the global economy, why Wall Street is terrified of losing control, and how this invisible shift changes the exact nature of money. To understand how we got here, you have to look at how a bank actually spends its money. Roughly 30% of a major bank's operating budget evaporates into back-office compliance, trade accounting, and fraud checking. It is process-heavy, incredibly slow, and prone to human error. When generative AI dropped, banks tried using it to speed things up, but it required a human to sit there, prompt it, check it, and hit confirm. Agentic AI changes the math entirely. Take Goldman Sachs or Lloyd's Banking Group. They are now deploying semi-autonomous digital co-workers. You don't prompt an agentic workflow. Instead, you give it a goal. Optimize our short-term liquidity across European markets while minimizing tax exposure. The AI then breaks that goal down into 50 separate steps. It analyzes real-time market data, initiates the trades, completes the compliance checks, and balances the books. It does in 3 seconds what used to take a team of 20 analysts an entire week. Lloyds expects this tech to unlock over £100 million in value this year alone. To the corporate balance sheet, it looks like pure magic. But to economists, it introduces a dark mathematical paradox. Every financial system on Earth relies on a single fragile variable: time. Human beings operate in seconds and minutes. If a market starts crashing, the human trader has time to panic, call a meeting, and decide to stop selling. The system has built-in friction, but when AI agents trade with other AI agents, friction disappears. Transactions happen at the speed of light. Imagine an AI agent at Bank A spots a microscopic anomaly in a routine corporate filing. It automatically executes a massive sell order. Bank B's AI agent detects that sudden sell order, misinterprets it as a market collapse, and instantly shorts the entire sector. Within a fraction of a millisecond, before a human supervisor can even blink or read a notification, a multi-billion-dollar chain reaction occurs. The industry calls this cyber convergence, because when the math is automated and instantaneous, the top-line revenue becomes incredibly efficient, but everything beneath it becomes completely unpredictable. Regulators are suddenly realizing that you cannot audit a machine that makes 10,000 decisions a second based on patterns a human brain literally cannot perceive. We are rapidly approaching what Accenture calls the 10x bank, a world where a single human manager doesn't oversee human employees, but instead manages an entire army of autonomous AI agents. The economic upside is staggering. The banking sector will become faster, cheaper, and more available than at any point in human history. But it leaves us with a profound question. If money is being created, moved, traded, and risked entirely by algorithms acting on their own authority, who is actually running the global economy? The banks will tell you they have full oversight. But history shows that whenever Wall Street finds a way to move money faster than the speed of human thought, the house always wins until the machine breaks. Until